Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 18th, 2020. In this video, we'll do both a brief update on the markets now that we're closed, so a closing market wrap, followed by a video on the agricultural commodities, some of the ones that stand out, just a look at the different charts. All right, and we'll do different time frames as well. I'll cover the ETFs as well as the commodity futures. So we're going to start out here with QQQ. QQQ did continue to move lower through the day. We had that rising wedge breakdown, bearish rising wedge. Again, this is a 15-minute chart. I'm really zoomed down here. Part of that is it reflects the decreased volatility. And what I mean by that is, back here when we were heading into the lows before the election, this is volatility. These are big swings. These are daily swings of 2-3% or more right there. That's volatility. Same to the upside. You had volatility to the upside. Big moves, both up and down, and up until this point. Remember, even after the elections, there was all the back and forth. It took a while after election day to finalize the vote count and declare Biden the winner. So there you go. And then since then, the volatility you can see clearly has abated. The moves are much smaller, so this is about as good as it gets right now. And if you're an active trader, from the point we back test today, it was good for about a 1% drop, and that first target's now been hit, 289.85, but we are at support. So that's pretty much where we closed the day, right at that 289.85 first support slash target. Should we break that tonight with the futures or tomorrow after the market opens, that would open the door to this 286.11 and possibly this support zone here about 282 up to 283. Look at ES real quick, or SPY. Well, let's do ES. Let's just skip over on SPY. Let's jump to the futures, and then we can get into the commodities. NQ. There it is. There was your breakdown. I should clarify, I said it a minute ago, it was about a 1% drop. It was a 1% drop from where I highlighted this morning where we were back testing after the breakdown. It was an objective short entry. Like I said, my convictions aren't super high right now because of this slow grind. The S&P 500, the broad market is grinding sideways. And even NQ, if you look at it right here this way, last few days we've been moving sideways. So again, because that is the bottom of that recent trading range, quite a few reactions there. I think if we can get a little more downside, it's going to open the door to these next targets on NQ and QQQ that I just covered. Otherwise, you could see a another move up, maybe another back test of the trend line, or even a break above there. So trade it as you want, active traders. It was about again a little over a 1% drop from that back test this morning, and you can either tighten stops now and let it run, see if you can get some more downside, or take your profits. I can't make a strong case to reverse long right now, so I'm just going to leave it at that and leave it up to each of you what you want to do if you are even trading the market actively right now. Swing trading, we're really going nowhere again. S&P popped to new all-time highs on that first positive vaccine result, had another lift the other day, but we're stalling out. That's unusual. It's not a red flag or anything, but it's unusual that we didn't. We've had some pretty good fundamental news, and it hasn't been able to push the S&P back above there. And today you can see we took out the bottom of that recent trading range right here, and actually just cracked below that 35.70-ish support, but not by a very wide margin so far. Any more downside tonight should open the door. If we can't snap back up in there quick, that should open the door to that next target there, 35.20 on ES, and if and when that goes, 34.60. Okay, so that's your update on the equity markets in under 4 minutes. Now let's talk commodities. I'm going to go through these in no particular order. What I mean by that is they're not, I'm not covering my favorites or those that stand out. I'm doing just a kind of a broad-based coverage of, again, we'll stick to agricultural commodities. If I get into the, the oil, natural gas, the metals and all that, this video will go forever. I want to cover the ETF for those of you that don't trade futures. We'll cover the ETF, or if there's multiple ETFs or ETNs, we'll cover those. Cotton, the most liquid one that I know of is BAL, and that one is in an uptrend. These are all lines. Again, you go back to past videos. You can search by post by ticker under the resources page and find previous updates on cotton. Just search BAL or $COTTON, and that should pull up all coverage of cotton. This is it's moved nice, and this is my point here. Commodities, I'm seeing, I'm not, well, we can call it a stealth rally. I don't know how many other eyes are watching, but I've been bullish on commodities for most of the at least since the first quarter here. And there's been a nice lift, since the March lows. Sure, the stock market certainly had a nice rally, but so was many of these commodities, up about 50%. And this is something I'm continuing to watch, because what I suspect, if everyone, somebody asked me the other day, Randy, what might put the brakes on this market? It just seems to go up, up, up. And my guess is inflation. And I think the Fed just came out and stated they don't think inflation is going to be a problem. I remember seeing a headline somewhere, whether it was Powell or another, somebody else in the Fed. But we see commodity prices continue to rise, and we know that housing prices and rents have been, especially in certain markets, going through the roof. Those are some of the biggest inputs. Food, in this case, is cotton, but again, we're seeing a lot of commodities moving up. And I think a case can be made that many of these may have bottomed and finished a multi-year bear market. And if that's the case, mark my words, that just completely starts to hand tie the Fed. Right now, they can print all the money they want. They can keep rates at zero all they want. And if inflation starts to rear its ugly head, they are going to have to start reeling that back in to keep to keep their 2% inflation target in check. Okay, there it is. BAL cotton, if you're trading the ETF or this ETN, I should say. Most of the commodity tracking instruments are ETNs. That's a pretty big resistance level. That's that previous reaction high. Here's an uptrend line to watch, but let's look at the bigger picture on cotton. Here's a weekly chart. When I jump over to these white charts, I'm using different charting platforms, stockcharts.com, and we're going to be using both daily and weekly charts of the futures. So this is, if I don't mention it, it's up here in the top corner, cotton weekly. So these are weekly candlesticks. Typically on my weekly charts, we're going back at least 10 years, if not longer. And you can see the most important thing on this chart that I would point out is, yeah, cotton has, it had a big run up back in early 2011 and then fell from there. And it's been moving mostly in a sideways trading range. This is a big level. If and when we get up here around $95, you can see that's capped all advances in recent years going back to 2012 right there. There's quite a ways before we get there, but let's just talk about what's happened more recently. All right, so you see down below I have some arrows. The arrows show the oversold readings, oversold being a reading of 30 or less on the RSI. I've put an arrow at every instance that we've had without exception, and what you can see is you wanted to be long cotton at that point. These are pretty significant rallies. I won't measure out the percentages here. I'm trying to keep the video and want to cover a lot of stuff, but from 65 up to $95, that was a nice run. Here you had that reading, and I should state that we really pretty much bottomed right after that. We're oversold. We continued to stay oversold right here. Yes, the actual bottom came months later, but just in percentage terms, not much lower. We effectively hit that same price, briefly dipped below it, and put in big divergence. And then again, big rally all the way, ultimately, before said and done, back to the 95 level. So there's a common theme. Here we hit oversold. We did go on to make one more low, and in pretty close proximity hit oversold again, a pretty deep oversold reading, in fact, closest to that one there. And so far that's that 50% run I just showed you. So and in that process we put in, you can see down here, here's the RSI, or I'm sorry, the PPO on the bottom, positive divergence on that second low right there on the PPO. That is positive divergence here, positive divergence here, positive divergence there. You can see what happened each and every time we had those bullish divergences. It set up the stage for a nice run, and again, that's what happened there. So said and done, we're at resistance now. That each of these lines, if it's green, these are support resistance lines you can add on stock charts. It'll automatically change a color for you. If it's a green, it means it's a support level, and once you break it, it turns into a red line resistance. So red is resistance, and that's where we're at right now. So there it is, a pretty good, pretty well-defined resistance level. So there, if we can pop that, There's your next resistance on my chart, and ultimately I think it can carry us up here to 95. We may not get straight there, but that's what I'd be looking at. And then longer term, that's what I wanted to talk on here. Ultimately, if you can break above that 95 level, that should be a very significant breakout that leads to a new, or tells you you're in the early stages of a new secular bull market. That would be a powerful breakout to take that level out. All right, let's not spend too much time on that, because that one right now, based on the fact it's at resistance, might not be the most subjective time to go into. But I cover all these. As you know, I'm a big proponent of having commodities as a part of your long-term portfolio. And what I'd like to do is micromanage. When the time is right, if BAL breaks out above this resistance level or pulls back to support, here's support around 65, or cotton futures, then that's where you may want to recycle and add to a long position. Next up is sugar. There are two ETNs to trade. Both are fairly liquid, SGG and CANE. I usually go to SGG. Again, my preference often is, if I can, I'll trade coffee or the futures, sugar futures, whatever the future contract. But these aren't a bad option. Most of them track pretty well. Some providers won't let you buy the ETNs anymore in your IRA, like Interactive Brokers. They don't want to mess with the K1 reporting. But you can use these in just about all other brokerage accounts, especially non-retirement accounts, and some brokers will let you buy them in IRAs. SGG, this is kind of a hybrid chart. We had an official trade back here. They had the stops clipped, but then I stayed on it, continued to post updates, posted this bullish falling wedge with big positive divergence again at the this was actually after the March lows. This bottomed in late April, looks like, and nice run in sugar. Again, here's a commodity that's run just in a few months, has rallied about almost 60%. And these are targets I laid out. I've had this $47 target for a long time there, and we're effectively there now. We're just a hair below it. Above that, next stop, if and when 47 gets taken out, would be about 48.90. However, you're getting close to my very near-term big levels. This is a big resistance level. That's where sugar's been checked almost every rally in the last few years here. And so the upside is limited now. This is more of an update for those of you long sugar. You have negative divergences building. Just as positive divergences were your catalyst for this rally off the lows, we could be looking at a decent correction, especially when sugar gets up there. Cane is your other ETF. And on Cane, you can see a little bit different chart. And again, different ETF or ETN company, but you still have the negative divergences. Now, I'll say this. This is more indicative of a bull trend. Look, we had negative divergences right here, and I believe I would have highlighted them. You can see them on the chart. And it did play out for a correction, but a relatively minor correction. We hit this trend line, and we pushed up. So what can happen in a bull trend, divergences sometimes get burned through, or they play out, but they play out for relatively minor corrections, and you can keep on working up and ultimately burn through the divergences. So either way, you cannot argue that sugar is not in a bull trend, or at least hasn't been since May. Bigger picture, yes, you can say, like a lot of commodities, still in a bear market. Too early to say with conviction that we're in a new bull market, but we're in a bull trend right now. And again, sorry, I had to check my phone. I had a phone call coming in. So that's, again, one that you might want to wait for a pullback to. Where would that be? 626, 598. But again, this one looks to have more upside in the long term. Let me look at sugar futures for you real quick. Okay, this is a weekly chart of sugar futures, $SUGAR. Long-term chart. Most you can freeze it. Look at all the other notes. You can see, look for these divergent highs that mark tops and divergent lows that mark bottoms. For example, this divergent low right back here was good for a 319% rally. Before all said and done, that rally ended with this divergent high, set up the stage for this big correction or bear market, whatever you want to call it. That ended with, you got it, divergent low, which was followed by a 140% rally, which ended with, you got it again, divergent high. So wash, rinse, repeat stuff. It's not always so easy, but bigger picture, if you step back and you look for these divergences, they often will help you identify major trend changes. And so what you have on since then, we had, well, first of all, this black line here is a major support level. You can see a lot of reactions going back for years on this black line about between 10 and 11 cents on sugar. And most recently you had a little dip down below, and that was I view that as bullish. Why? Because a breakdown. So you might say, Randy, why is a break of support like that bullish? Well, at the time it wasn't, although I can't recall, but if I was covering this, I probably would have pointed out there were bullish divergences intact. But then more importantly, the fact we broke down and quickly, very impulsively recovered, that makes this a bear trap, aka whipsaw signal. The bears pile in, they short a break of 10 cents, thinking sugar is going a lot lower, and when they realize, especially with an impulsive move back up, they were wrong, they have to cover, and the shorts covering leads to buying pressure, and boom, that was a big snapback. Took us right to resistance here. You can see a pretty big resistance level right about where we're at now, 15. So longer term, being the fact we just put in this big divergent low. Remember, I pointed out this divergent low back here, August 9th. These are notes that means I would have posted the chart back then, I believe, on August 9th, 2018, and that was good for a 57% rally from there. This time around, we put in even bigger divergences. They start at the same point, but they're much larger. And so therefore that would project for a larger rally, even the start of a new bull trend. So I think sugar can keep going. We're at resistance. It may correct. It may need a healthy correction. But this is one, again, as a long-term investor, just like everything I've covered so far, if I had to either go long or short, throw away the key, lock it up for a year or more, I would be long, even if I had to ride out pullbacks. So that's where we're at. But again, at resistance, why add now? Either wait for the break above resistance or wait for a pullback, get in at a better price, and that's sugar. Cow is a ETN that it's a livestock ETN. It holds both cattle and lean hogs, you can see on here I have it at resistance, a pretty good resistance, about 34.91. It's been checked at that level a few times. It broke this uptrend line, and it also put in negative divergence there. It's been moving lower. Again, most commodities are in an uptrend. Typically, a lot of times you'll see when the grains are rallying, that puts pressure on livestock, because that's one of the biggest input to the farmers. They've got to feed their the livestock, and they're feeding it grains. Feeding them grain. So I'm a little more bullish. Well, I'm more bullish on the the grains, I should say. I'm sorry, wheat and corn, soybeans, things like that. You could diversify by having livestock, but look, they both rallied. Again, this is the point. I'm seeing just broad-based participation rallies. This is about a 32% rally off the April lows right there, and there's a downtrend line would be your next target. I'd prefer to see cow come on back down to about that 3180 level, let these divergences play out, see how it looks there. I'll have to zero in. I don't believe Stock Charts has. Let me see if I have the futures. Yeah, I don't think Stock Charts has hogs or cattle, but this is another platform, and here's live cattle. LE is the symbol. And I can't make heads or tails of this chart, so I don't have a strong opinion. This is a 6-month, 2-hour chart, 2-hour candles. There it is, kind of messy, going round and round. And then HE, these are your lean hogs, and we were just looking at live cattle. And all I can tell you, just like COW, that ATM, we're just looking at divergent high right here recently, and it's been correcting, not very hard, but again, I don't have a strong opinion, so I'm going to move forward and tell you that that's where we're at. You guys can make heads or tails. If I see a trade up there, I'll let you know, but as of now, I'm kind of neutral on cattle and hogs. Okay, next up, soybeans, SOYB is the ETF. I believe this is up about the ETN, or actually, yeah, ETN to be technically correct, not an ETF, is up about 35%, but the futures are up about 45% off these lows here. So again, just something strong, nothing but bullish price action. Was highlighted back then. We had this little wedge type pattern here. You had a big divergent low. This is positive divergence when your indicators are making these higher highs, prices are making lower lows, and just like you had a smaller divergence here right there that led to this rally. So boom, this one you broke out. I was highlighting this trend line back here at the time where you could buy pullbacks to or keep a stop under it and let it run, and boy, it just took off and boom, to the moon, Alice. However, it does have negative divergence. I don't have big resistance here. But there is some overhead supply. What I mean by overhead supply, all these trades back here, it's stalled out, had a period of consolidation for a while, and it's coming up on that. So the risk reward at this point in time does not look very favorable. If you're in it, great, but I'd also consider raising stops right now to protect profits. If you're a very long-term investor, you just ride out the big pullbacks, and you might be in the early stages of a bull market. But again, I'd wait for a pullback. Where to? 1683 right there. That's great support if we get it. And there's a gap below, so maybe give it a move down from anywhere. Start scaling in around 1690 or 17 down to about 1650 with a stop below $16. That's also big support right there if you want to recycle in. If we get a correction. When you look at the futures, this is a weekly chart. Nothing but bullish to me. I mean, this is a great chart right here. What I see, well, you can see divergent high, get out. Divergent low right here, get in. That divergent low back here in 2005 was the catalyst for this entire bull run here. Had a divergent high there, big correction. Then had another thrust up, put in a divergent high again. Bigger correction, actually bear market. That ended that bull run. Back here, during this correction or bear trend, I should say, we put in a divergent low and we had a nice sharp rally. Most recently, we put in a divergent low here. There's your positive divergence. RSI's up top here. PPO's down on the bottom here, and boom. But what we did this time that was different than the other bear market rally is we took out this bear market downtrend line. So that's a breakout right there, and you can see we're coming right up on this reaction high right now, hence in quite oversold. You can see here, or overbought, that is, overbought right there. We were overbought there, see what happened after that. We were overbought there, see what happened after that. So again, most objective to wait for a pullback anywhere in there, and then cycle in for what may be a new bull run, like this. So if you're saying that's too much too fast, well, just go back here and look what happens. So you get these corrections along the way, but I love trading commodities. When they want to run, they can really run, and they can defy, overbought can continue to just become overbought or more overbought in a bull trend. So that's what we're quite likely in now, in my opinion, after taking out this downtrend line. JJG, I've covered this many times. If you want to kill 3 birds with 1 stone, this is your ETN. It tracks the price of corn, soybeans, and wheat. So your 3 grains, it's the grain ETF or ETN. Simple stuff. It was highlighted back here. Nice, clean downtrend line, bullish falling wedge pattern, breakout. If you missed the breakout, it gave you an even better buy opportunity back here on the back test, and that came on the heels of strong positive divergence, and that's all she wrote. JJG has not looked back since then, rallying about 32% in a matter of 1, 2, 3, just over 3 months. And so again, a lot of opportunity there. However, again, like a lot of these, getting stretched, coming up, you have a reaction high there. We're coming up on, we have an uptrend line to watch. We have divergence only on the RSI, not on the PPO yet. But a break of that trend line could bring us back in. So if it comes back here, I think that would be a nice re-entry point or add-on point if you're swinging it long or holding it long as an investment, wanting to add to it. If we get a pullback, and we may not, but if we do down to around $46, that's a nice support level. So we'll see how the indicators look if and when we get that. And of course, the catalyst would most likely be a break of this uptrend line right there, the price channel. Wheat, another one of my favorites. We've just, caught almost all, whether they were official, unofficial, all the big rips and dips in this one in recent years. It's been a great swing trading vehicle. Trades just so well to the technicals. I mean, you have these positive divergence. We look for these divergent lows. These would have been usually official trades if they're listed like that. If not official, unofficial. targets were there, and so the big picture is we've had these ops right here, trading ops. Wheat looks to be pounding out, what could be a major bottom right here, and within that we've had these just very tradable trends, and a lot like the other, lot of the other agricultural commodities like coffee, which we're in right now. When they run, they really run. So there was a breakout. It was a beautiful. I mean, this is just a great example of technical analysis. Bullish falling wedge, breakout, boom, run up, hit the targets, reactions at most of those targets, set up the time. I believe it was pointed out at the time as well, negative divergence at resistance. You get out, you're short if you want, pull back to support. So that's it. It's been wash, rinse, repeat. Every time that wheat has fallen down to this 490-ish level right there, it has capped all pullbacks. And every time it's got up to the top of the trading range here, it has capped all rallies. Sooner or later, and I think sooner, I think this will probably be it. I don't expect another run back down. I think we break out, and then the evidence will start to mount that these aren't just bear market rallies, but rather the early stages of a new bull market in wheat. Too early to say that with confidence or conviction, but that's where I think we're going. This one actually had that was divergence there on the RSI that marked that top right there. I should add that line there. Okay, so where are we at on it? Again, I think we'll probably break out soon. We've hit this level quite a bit, so if we can pop over the recent highs around 610, I think that should do the trick. I don't know if we're going to get a deeper pullback. We've already had a pullback off the 610 level. I mentioned that recently when this fourth target was hit, and we did get a correction. So right now I don't see negative divergence. The indicators are in constructive or bullish territory. They're above the PPO is above the 0 line. The RSI is on or above the 50 level, which often defines bull and bear trends, when you're above the 50 level, and 50 often acts as support on pullbacks. So a pretty constructive chart. Again, you're flirting with your under major resistance, so is it the most objective time to enter a position if you haven't had one? No, but if we can get a solid breakout through there, I think so. Let's look at the long-term chart of wheat, and I'll reiterate why I've been bullish on wheat for a while and buying those lows. It's this. This is a very long-term trend line. We're going back to the dot-com days right here, 2000, for those of you that have been around that long and remember that. But again, this is wheat. This is a commodity. Unlike all those dot-com companies that went bust and are long gone because they went bankrupt, they didn't have business models, they didn't have earnings, so they went to the wayside. Wheat doesn't go that way. Wheat never will file for bankruptcy. That's the one guarantee I'll give you. So wheat's not going to go to zero. We all know that. And it's in a secular bull market. Here's our uptrend line, and it's been pretty simple stuff. You buy pullbacks to that trend line. And we've hit that trend line. Once you get in a strong bull market, you'll start to walk away from it. This was a parabolic run. There was a parabolic trend line. And parabolic runs typically don't end well. Now, we're not there yet. We're not even close to being in a parabolic run, but we could be. If these commodities start to get some momentum, everybody starts to, let's say, pull money out of, there's a tremendous amount of money that's been pumped into the stock market via the Fed, money printing and liquidity, and also people chasing yield, for forever, really, not just decades, forever. There have been a big part of the market has been bond buyers, pension plans, retirees, people that need fixed income. And one of the things the Fed's done by their own admission, they forced those fixed income traders out of safe haven investments like bonds into the equity markets. That's one reason that they lowered rates, and they've actually come out and said that publicly in the past. And we all know that to be true. So that's we're at a zero rate environment. You can't get on bonds. So we make one day, you could see a momentum trade build in these commodities where people see more intrinsic value, relative value in the commodities than they do in the equity markets, and that could lead to, is all I'm trying to say, another parabolic run. And it doesn't have to be a parabolic run. You can have a nice, good old-fashioned bull trend. Okay, but until then, here's where we're at. We're above the bullish trend line, and we're at a pretty significant resistance right here. Actually, take that back. I showed you resistance on the ETN, but these are the futures. These you want to put a higher weighting on. And right there, about the $600 level was a previous was resistance, and we recently popped that, and we're pretty much back testing right now. So again, you put a higher weighting on wheat futures. Why? The ETN we just looked at, WAT, is trying to track wheat prices by using futures, but they run into expenses that you don't if you're a futures trader. That you have to roll, but you're rolling one contract. You know, that's a ETN company is rolling multiple contracts. They have higher fees they incur, and so you know, always put a higher weighting on what the actual futures contract for commodity, how they're doing than the actual ETNs, which will lag behind. I think I gave you an example a minute ago on one of the commodities that has rallied 45% off the lows. I measured it out, but yet the ETN only rallied 35. So there's one case of the, you know, underperformance that is inevitable, and hence another reason I like to, you know, pure play trade the commodity futures over the ETNs. Next up would be corn, the ETN, easy symbol to remember, CORN. You have corn hitting my second target there, 1422 recently, and that's pretty big resistance. So here's another one that I remain longer term bullish. However, we're at by far the most significant resistance level that we've been at for quite a while. You know, looked like nice bottoming action here. It was beautiful. We had a nice sharp downtrend line, bullish falling wedge there. We retested those lows. Boom, boom. That was a marginal new low, slightly lower low with stronger, much stronger, more powerful divergence, and that's what it took. Boom, those divergences played out, and that's been a 25+% rally right into resistance. So no, I would not take corn here today. Again, the grains are, you know, kind of at resistance there. Ideally in a pullback. Sometimes they just keep going. You know, I've gone over that recently. I talked to you about coffee, why I'm not trying to micromanage that trade now, because when it can run, it can really run. The grains can sometimes do that as well. But again, with that being said, that's a pretty big resistance level. I don't have coffee at such a strong resistance level now. So I would expect a pullback. Where to? Well, we've already pulled back to 1319 once. We did it right here. We could certainly do it again. If we do, great. We have negative divergence. So unless these divergences are burned out, and that could happen. We could punch through here, run up to T3 or T4, burn through the divergences. But let's look at the bigger picture. Let's go to the weekly chart. I just want to show you right now where you might get an objective entry. Ideally on a pullback, work off these overbought conditions and divergences. And when we look at the weekly chart of corn futures, what I see is, again, a big potential basing pattern down here, right here, going back multi-year. This goes back to late 2014, and you can see that corn has been bouncing around. This is a support line right here. We've had a couple, you know, short, relatively brief breaks below, and you can call it a support zone down from about here to here. That's about 300 to 340 right there. And then here's your resistance zone up top. I would have boxed that in, but my box tool, I have to change color. Here's my box tool right there. It doesn't show well right here, so I'm going to use this dark circle tool right now. And that's it. Boom, 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 boom. This won't last forever. Nothing lasts forever as far as trading ranges go. Sooner or later we'll break out, and I favor an upside breakout. Why? Am I just being, you know, just guessing that the commodities may be about to bark into a longer term bull market? No. There's a technical case can be made. And that technical case right here would be this positive divergence that has been building right here. Last time I had positive divergence on my weekly chart was right here. That led to a 180% rally from there. The time before that was right here. We had positive divergence. That led to a 316% rally. So that is why I favor ultimately a breakout of this range. It's because of the bullish divergence, especially the scope of that divergence hasn't, in my opinion, played out for the move that it is forecasting or projecting. Next up is JO. JO is the coffee ETN. This one I've been covering quite a bit lately, been on top of this one. Nice bullish divergence here on the daily chart on that pullback to 3060, as I've covered in recent videos. You know, we've had similar to some of these other commodities, quite a few pullbacks there. This one was very bullish because we broke that long-term support, but then regained it, and then boom, had a big rally. So this one's also been a very tradable vehicle. Tends to trend very strong. In other words, you get an uptrend. They're mostly unidirectional, as I've covered before. You know, in other words, when you get those, when you hit the final targets and you have negative divergence to boot, get out, take your profits. You know, some people like to hold, but even as a long-term investor, I don't want to ride out, these 30, 40%, 20, 30% pullbacks. I'd rather short them and or wait for the next objective long entry, which was right here with its divergent low on that pullback to 30.60. And then again, I've been highlighting it recently on the 60-minute chart as well, and the 60-minute chart of the futures. We've been inching around, putting in divergent low right here on the 60-minute chart of JO as well as the futures, and then finally it started to run since that divergent low, up about 18% just a couple week or so here. And this is the one I've been covering quite a bit, is KC coffee futures on this 120-minute chart. So there it is, just a nice clean bullish falling wedge pattern, divergent low there, put in a marginal new low. We kept the divergences going and building, and then boom, finally broke out and hasn't looked back so far. Just cleared my 122.26 target today on a momentum fueled overshoot, pulled back and parked it there. So that's where we're at now. Are we overbought? Yes. Could we correct and pull back to any of these lines? Absolutely. But again, coffee, when it wants to run, can really run. So I'm treating this one right now as a longer-term trend trader investment. And part of the reason for that, as I've covered quite a bit in the past, is a weekly chart. What it tells me, again, look for these divergent lows, big rally. From that point, divergent high, correction, divergent high, correction, divergent low, rally, 126%, divergent high, correction. And most recently here, we put in a divergent low. And this is way back when, in 2019, I called for a first target of a 60% rally. We went 1% lower and then hit it for a 61% gain. Then a 90% next target is up here, 170, my longer term target. And that would be, again, from this point where it was mentioned on this bullish falling wedge breakout, that was 90%. Not from where we're at today, we're a little bit above there, but I think that's what happens. I think we continue up. We've already checked that 140 resistance once. We could have another reaction there, or we can just power right on through and head up to that 170 target, which is the next target for coffee. And then ultimately it's buried behind here, but I have another longer term target about 230 right there. Okay, we're almost done. This one is NIB, which is the cocoa ETN. This is another one. It's like using the Staples easy button. It's been highlighted back here for a while. This is our primary uptrend line on the daily chart. That's what we're looking at here. And the last objective long entry was highlighted right here on the pullback to that trend line, just like this pullback, just like that one, that one, that one. And this one was even better because we had bullish or positive divergence there. And from that point, we rallied up roughly about 33%, pulled back, overshot this 27.54 support by a bit, but we're back to that 31.12 resistance. Grinding around near term, where does it go? Well, I think we can work our way back up that 34.90. It's a pretty big level on the ETN right there. You can see that. When I look at the long-term chart, I'm not crazy about it, so I will say not one of my favorites. It is a way to diversify. This is a weekly chart. You had these clear divergent highs right here, and that said get out or short cocoa. There was a small divergent low right there. Actually, it should be added. That line should be darker. You probably can't make it out in the video. And that was a catalyst for that rally. But most recently, put in a divergent high right here. There was your negative divergence. And then we did have positive divergence on the RSI right there, and that was a catalyst for that. But when I look at this, we're kind of in this big sloppy range. Longer term, if we can break above these two reaction highs, bullish, and there's not a clean uptrend line to draw right there. So again, I'm going off that daily chart at NIB. That's the one I'd focus on now. I just wanted to cover this weekly chart and give you my opinions, and that I'm not, I don't see a screaming long-term buy here. But again, if you get that drift up, remember, if most of the commodities are going up, a lot of investors will buy commodity funds, ETFs, and mutual funds that are spreading it among all these. So some of the other commodities, even if their charts aren't as strong, can often become beneficiaries of inflows into those commodity funds, because that creates buying and across the board. And last but not least, DBA. That is a one-size-fits-all for agricultural commodities. So I showed you a JJG, but that only had the grains. If you just said, okay, Randy, my head's spinning. I like what you're saying about these commodities, or at least, may not see what you see, but I want some exposure there. Well, this is, again, a one-size-fits-all for agriculture commodities. It doesn't have oil, gas, and metals and all those other things, just mostly everything I just showed you. Simple view is this long-term downtrend line right here. You can see it goes back to 2016, and we're testing it now. So breakout of that would be bullish. Like everything else and quite a few things I just showed you right now, it is at resistance. And there's also some negative divergence forming. So is it the most objective time to add to that? No. It'd be ideal to see a pullback, maybe down here at about 1450, power up, work off these divergences, and then get a breakout. However, we could break out until then, and if we do and it's impulsive, then that would be a buy signal. That's the simple version. Here's the more complex version. This is the chart that I've shared many times over the years with more annotations. I haven't updated this, you can see, in a while, but the ratios will change a little bit, but you can see you've got them all: cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs. You have live cattle and feeder cattle, and then cotton. And so that's pretty much everything I just covered. Downtrend line that I just showed you, the primary downtrend line. There's a secondary longer term trend line. We had a basing pattern here and then broke above that. So that was our, and highlighted at the time, an objective buy signal when we broke above the 1390 resistance, and that was a catalyst for this rally. I just need to move my divergence line up a little bit here like I had on that other chart, and that's it. So at resistance, I still like the long-term outlook. But the odds favor maybe a reaction pullback here, maybe a little consolidation, and we'll just keep our eye on this for a breakout for the next buy signal. Okay, long video, but I covered a lot there, so hopefully you find that useful. And again, that kind of adds or meshes in with the video I did earlier on the trade ideas, and I had quite a few of the ag input companies, fertilizer companies, companies that should benefit from a strong agricultural commodity rally in the ag commodities. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.